Hi everyone, this is Bill Even, your CEO at the Pork Checkoff here in Des Moines, Iowa. I'm here today to introduce Nathan Kauffman, the Senior Vice President for the Federal Reserve Bank of Kansas City. Nathan is going to give us an overview of the U.S. economy and the particular implications for U.S. agriculture here as we start the summer of 2023. Nathan, over to you.
Thank you, Bill, for the introduction and the chance to share with some of your members developments that we're watching as it relates to the U.S. economy and implications for agriculture. Appreciate the chance to be able to speak to people today. Just by way of introduction here, before I get started with the presentation, my name is Nate Kauffman. I am with the Federal Reserve Bank of Kansas City, and I serve as our branch executive in the Omaha office of the Kansas City Fed. And some of you may know the Kansas City Fed covers a region of 7 states in the middle of the country. We, of course, have a very high concentration of agriculture in the region that we serve, and that is an area that I'm heavily focused on in providing input for monetary policy as it relates to the Fed. So pleased to be able to share some thoughts that we have with respect to agriculture and how that ties into broader economic developments. I'll spend most of my time actually talking about some of those broader economic developments, recognizing, of course, some of the uncertainty that's facing certain segments of agriculture, and in particular the hog industry. So my aim for today's presentation is just to provide a little bit of information about macroeconomic developments in agriculture and how that translates into developments that we might be seeing with respect to agriculture. So just to get started and provide a couple of outlook themes, and again, I'll touch on components on the U.S. economy at large before getting into some financial developments in agriculture and more specifics there. And as seen on this first slide with some of my outlook themes, I'll describe the economy as having slowed recently after some sharp gains in 2021 and early 2022. And as I'm sure most of you are aware by now, this has happened alongside sharp increases in interest rates and ongoing inflationary pressure that has, of course, proven challenging for both businesses and households. In general, the agricultural economy has been in a strong place in recent years, despite some of the slower economic growth and reduced profits in recent months. And of course, this is not necessarily true for all industries within agriculture, but just as a broad stroke in terms of assessing the overall financial and economic development as a sector. So moving to the first slide and talking a little bit about some of these broader economic developments before diving more specifically into agriculture, I think one of the first places to start is just by recognizing the scale of increase in interest rates and how this has played out over time, which of course has a significant impact on producers that have a large amount of borrowing or leverage as it relates to their operation. As you can see on this first chart, interest rates have increased sharply over the past year and a half. As we look at various measures of interest rates, the federal funds rate is the interest rate that the Federal Reserve has control over, and that's shown in the blue line, which had been at near zero for really about a year and a half with the onset of the pandemic. Of course, was near zero for many years following the financial crisis. But the increases that we've seen since 2022 have been sharp and some of the fastest increases in interest rates going back many years, as you can see there in that blue line. Of course, other interest rates then are built off of these interest rates that the Fed ultimately is adjusting. And as shown on this chart, for example, the 30-year fixed mortgage rate having increased from a rate of about 3% in 2021 to one that has been north of 6% for most of the past 6 months or so. So what I think a lot of people are experiencing with respect to financial pressure ties directly into some of these developments as it relates to interest rates. As shown on the next slide, though, the primary goal of these higher interest rates has been to reduce inflationary pressure that we started to see intensifying last year. The Federal Reserve has a goal for inflation at 2%. And there's not necessarily anything special about this rate of 2%, but just that it's something that's slightly above zero. And the Federal Reserve has indicated that this is the goal over the long term, is to hit that 2% target. As you can see on this chart, when we look at a measure of inflation here referred to as the Consumer Price Index, this rate of inflation has been at 2% or had been at 2% for really a number of years before the pandemic. But in 2021, we started to see these inflationary pressures rise. I'll describe some of the factors behind that, but ultimately what you're seeing here is an increase in inflation from about 2% to something that was closer to 10%. We often refer to as other measures of inflation as a core measure of inflation that you'll sometimes hear people talking about food and energy separate. Even that measure of inflation, though, once you take out the volatile prices associated with things like gasoline and other energy, has still been rising at a fairly sharp pace. It has been coming down recently, and that's generally positive. But again, going back to the earlier slide, it's the inflationary environment that ultimately has been driving the increase in interest rates to get that inflation back down to something that's closer to 2%. On the next slide, I want to talk just briefly about where some of this pressure of inflation has come from over the past year and a half. And again, so much of I think what you're probably experiencing as businesses making decisions that's tied to interest rates and financial pressure is coming about because of some of these inflationary pressures. It's important to recognize that we experienced some pretty dramatic economic growth in the wake of the pandemic that ultimately fueled some of the inflationary pressure that took off in 2021. We all know of the supply chain disruptions and delays and other things that ultimately caused some of those pressures. The chart on this slide is showing a measure of economic activity that we refer to as real GDP, gross domestic product, for both the United States, but a number of other countries. And the main takeaway on this slide is to realize that after an average growth of around 2 to 2.5% from 2017 to 2019, the U.S. economy grew at a rate closer to 6% in 2021. So that was rapid growth that ultimately fueled inflation and probably wasn't sustainable. And as I'll talk about here in a little bit, what we're now seeing with some of the pullback in inflationary pressure is alongside some of the reduced economic activity. The next slide is looking a little bit more specifically in terms of agriculture and recognizing that this has been part of the inflationary story and also part of the reason that ag has been in a relatively strong financial position. Through 2020, ag commodity prices accelerated pretty substantially. They continued to rise through early 2022 alongside the invasion of Ukraine. The chart on this slide shows the commodity prices for several of our major commodities in the United States, recognizing that most of those had increased quite rapidly in the months following the onset of the pandemic. Of course, wheat prices were a bit of an anomaly with the war in Ukraine. Many of these commodity prices have started to pull back, of course, from their highs last year. As it relates to crop prices, they're still quite high relative to where they had been before the pandemic. But as I noted at the outset of this presentation, there are some commodity prices, specifically in the livestock sector, that compared to where they had been, say, 3 or 4 years ago, are not all that high. And again, still experiencing the cost pressures that I alluded to in the rest of the economy. On the next slide, what I mentioned at the beginning to say that the U.S. agriculture has been in a strong financial position is maybe best summarized by my slide here showing U.S. real net farm income. Farm income in the U.S. increased sharply with those increases that I described in commodity prices that began really in 2020. Much of this was government payments, but in addition to government payments was also a dramatic increase in export activity of commodities, specifically to China. And as I'll describe on the next slide, a lot of that support has remained, which is where some of the strength in agriculture has been the last few years. As you can see on this slide, even though we're expecting a slight pullback in farm income, broadly speaking, in 2023, it's still quite high in a historical context. And much of this, of course, is being driven by the high commodity price and profit margin environment in the crop sector, but others still experiencing some gains. As I mentioned a minute ago, though, in addition to the government payments, export activity rebounded quickly after the pandemic, and it continued to strengthen through 2022. It's been a support for U.S. agriculture overall, notwithstanding some of the concerns that I mentioned at the very beginning about slower economic growth that we're expecting in 2023. The chart on the left on this slide simply shows an overall measure of U.S. agricultural exports, and the point to note here is just simply that exports were record high in 2022. That's going back even to 2014. And it's, of course, dramatically higher than what we experienced in the wake of the trade disruptions with China in 2018 and 2019. And then, of course, the early months of the pandemic in 2020. When we look at where some of the strength is coming from in terms of agricultural exports, again, much of this is in crops and grains and oilseeds specifically. We've seen gains in other areas, but specifically with demand from China, This is what's been driving some of the resurgence in export activity, specifically soybeans, but also corn. On the next slide, what I'll spend just a couple minutes talking about then is how these increases in farm income and commodity prices have ultimately supported finances for many operations across the country. During those years from about 2015 through 2019, farm real estate values had more or less been not increasing, but not really decreasing either, mostly moving sideways. And as you'll see on this chart on the left, from 2021 through 2022, we saw pretty dramatic increases in farm real estate values. The data here is from USDA, so it's at the national level, showing a 15% increase in 2022. Of course, there are parts of the Midwest or other places concentrated specifically in crop production where these increases were probably closer to 25% as opposed to 15%. But it's important to recognize that that increase was built on what had already been a very high level of farm real estate values. So when we look at the overall assessment of farm finances in the United States, this indicator, perhaps above many others, would suggest that a lot of producers are in a strong position because they have very high levels of equity to draw on that's built up into farm real estate as an asset. One of the other things that we talk about, though, as it relates to the strength of farm finances is maybe best shown in the chart on the right here, which is to say that farm loan delinquency rates have also been at historic lows. This is true both at commercial banks, as shown in red, and at the farm credit system, as shown in blue. As it relates to commercial banks, delinquency rates have been as low as 1%. They had been rising steadily until the pandemic. Those years leading up to the pandemic were actually a bit challenging for agriculture, with relatively subdued commodity prices and lower profit margins. We've seen those delinquency rates come down, though, with the profit margins in agriculture in general, and again, fueled by some of the increases that I've mentioned earlier. On the next slide, I want to get back, though, to some of where I think we're seeing more of the recent weakness or sluggishness in economic activity that I think other businesses are probably experiencing in more acute ways, but I think ties back to what we're observing as it relates to the broader economic outlook. Recall that I mentioned earlier that GDP in the United States grew in 2021 at a rate of 6%, in contrast to maybe what was perceived to be more normal as 2%. At the end of 2021, the forecast for 2022 in the U.S., as shown in the far set of bars here in blue, was that we would still be growing at a rate of 4%. As the war in Ukraine progressed, however, that growth rate was essentially cut in half, and 2022 ended up showing a rate of growth of just 2%. Alongside some of the increases that we've had in interest rates, the inflationary pressure that I mentioned earlier, the forecast for 2023 is even lower. And we're probably looking at a rate of growth for this year at somewhere right around 1%, and then growth in 2024 at around 0.5% for the US. As you see in other countries, it's not just the United States that's showing some of this slowdown. You'll see it in other places as well. But the point that I really want to make on this slide is that even though this sounds like small numbers, moving from an expected rate of growth from 4% to 1%, it has pretty far-reaching impacts. And a slowdown in economic activity generally is felt across lots of different segments of the economy, including agriculture. And so I think that there's probably a certain amount of trepidation that many businesses are experiencing and feeling with respect to some of the slowing activity. It's not necessarily to suggest a recession is imminent, but of course, those are some of the pressures that are being talked about with the sharp increases in interest rates and the slowdown that's alluded to on the slide. As it relates to agriculture, too, we're seeing some of the slowdown there play out in terms of reductions in commodity prices. So shown on the next slide is a set of, again, the major commodities that we would track nationally, and simply showing how far they've fallen from their high point in 2022. You can see, for example, in the case of milk prices, they're off about 40% from their highs. Wheat prices are still high, but they're also down about 30 to 40% from where they were. And of course, the hog industry is facing significant challenges, as you all know much better than me, in terms of reductions in commodity prices, but also the heightened expense environment that I alluded to earlier, of which interest rates is a part. The chart on the right-hand side of this is to try to break down what some of these costs look like across the entire U.S. ag sector. Interest expenses are a significant component of cost, but they're only about 7% in total. So what you'll see on this chart on the right is that interest expenses have in fact been the category of expenses that has shown the most significant increase, and looking at the difference between the blue and the red bars on this chart. But you'll also see as you look at the rest of this chart that there aren't many cases where other expenses have come down from last year. And so what this ultimately means is when you're looking at a lower commodity price environment with input costs that are either remaining high or even increasing further, is that you're looking at an increase in stress when it comes to reduced profit margins and perhaps even losses. Moving back to some of the broader economic themes, and I'll end with a couple of these charts just to allude to where some of the ongoing strength has come from in the U.S. economy, such that we're not necessarily looking at a recession that is imminent. And this is coming from a couple of places. The first is that consumer spending and household wealth has remained high. We've seen some of this growth soften considerably in recent months. When we look, for example, at consumer spending, we of course saw the dip in the early months of the pandemic that's shown in blue here. But pretty quickly after that pandemic, consumer spending started to rebound. And again, some of this was because of the government stimulus that was rolled out. Through the end of 2022 and into 2023, though, you can see that this line is pretty flat. It's still elevated from where we were before the pandemic, but we're not seeing the same kind of growth that we had been seeing from 2020 through 2021. Home prices are another important measure of household wealth. And there too, you can see the rapid increase from 2021 into 2022. But we're seeing median home prices, for example, also not really moving up much for the past 6 to 9 months. And in some places, of course, seeing some declines. I also want to spend just a minute talking about the labor market on the next slide, because the strength in the labor market has ultimately been one of those factors that has most supported consumer spending. I think it's one of those things that supports, even in agriculture, supports some of the ongoing investment opportunities and activities, recognizing that there has still been a number of opportunities off the farm. The chart on the left simply shows that the unemployment rate is very near all-time lows at about 3.5% nationally. That's shown in the blue line. And in the red line, and another number that we often use is job openings to indicate that the number of jobs available in the U.S. economy is still very high compared to where it was before the pandemic. Just another indicator to suggest that the labor market has been very strong despite some of the slowing economic activity. The chart on the right then shows another measure of the labor market of average hourly earnings as a percent change from the previous year. And it's important to note that this is a percent change, because for the most part, when we talk to businesses about how fast they're increasing wages from one year to the next, before the pandemic, it was pretty regularly between 2 and 3%, not much change. Coming out of the pandemic, it was very different. Businesses feeling pressures related to hiring, not being able to find workers, those wage pressures increased substantially. And through 2021, it was more common to hear of increases between 5 and 6% and some as high as 10%. We have seen some of those wage pressures come off a bit, as shown in this chart on the right, but it's important to note that we're still looking at wage gains that are higher than where we had been before the pandemic. The last chart that I want to end with, and I'll make just a couple concluding points, and hopefully, again, this information is useful to viewers today. But looking ahead, the pace of economic activity, I think, is going to be significantly affected by the two things that I started this presentation with: the path of inflation and ultimately interest rates. Interest rates, as I alluded to earlier, are largely responding to the path of inflation. If there is substantial progress moving toward the target of 2% for inflation, then there won't be as compelling of a reason to need interest rates to be as restrictive as they are. But on the other hand, if we're seeing inflationary pressure, those interest rates will still be restrictive. This chart is simply to illustrate, though, just how dramatically the interest rate environment has changed relative to maybe what was believed could be the case back in 2020. This chart shows projections from the Federal Reserve of the federal funds rate, which again is the interest rate that the Fed controls. And the blue line is showing the expectation of those interest rates as of December 2020. It was viewed at that time that interest rates would still be near zero through 2021, through 2022, and even into 2023. And we now, of course, know that that is not the case. And the red line shows current projections. And interest rates in 2023 are expected to be somewhere between the 5 and 6% mark, potentially come down longer term to something that is viewed as more long run normal, but this is still, again, a substantial difference in 2023 relative to what might have been expected a couple of years ago with respect to interest rates. All of this is to say that the increase in interest rates have been a significant adjustment for many operations, especially those that are relying on debt to help finance, year-to-year operational expenses. Of course, that can be many operations. But again, I think as we get a sense of the outlook going forward, the path of interest rates will be tied to inflation. So let me just wrap up here quickly, and I'll conclude by noting that profit margins, I think, are likely to still be thinner in the months ahead, even though we have seen strength in recent years. That's coming off of some of the fading in commodity prices and recognizing that costs are still quite elevated. When we look at our data, though, as it relates to measures of farm finances, the amount of financial stress in ag is still likely to be limited. But that's recognizing that some industries are facing significant cost pressures, and it's not going to be uniform everywhere. Much of the strength is being driven in ag by the crop sector. Lastly, I think it's worth emphasizing again that labor markets still appear likely to remain strong, providing support for household spending. But as I mentioned earlier, interest rates and inflation will be ongoing challenges that producers will need to contend with. So I hope this information has been useful just in gaining some broader context about what we're seeing with respect to economic developments and where some of the slowdown is occurring, and how that slowdown, though broad and aggregate, likely is having significant impacts across many segments of the economy. So I appreciate everyone's taking the time to view this presentation. Of course, feel free to reach out to us at the Federal Reserve if there are questions that do come up. And Bill and others, thanks again for the opportunity to address your members today.
Thanks very much, Nathan. And remember, for those of you watching this video, please go to portcheckoff.org to sign up for email updates and more information like this. Thanks much, everyone. Have a great summer.